Guys, here's Doc's Market Minute for Friday, September 18th. Now, this morning I'm sitting down going over the September cycle. This is something that I do every month is I go over the results of the cycle and I look to understand what we did right, what we did wrong, and what needs to be changed for the next cycle. It's something I advise everybody to do, is to go through this continuous improvement process around some type of formal structure. In my mind, it works best for option traders that are doing this once a month around the expiration cycle, to kind of sit down and inwardly focus on what you're doing and make sure that you're doing it right and what can we do to improve for the next cycle. So I'm putting my numbers together and I realized that I actually had a great month. A lot of times I won't sit there and tabulate how I'm doing along the month because I prefer to keep that separate so that my performance is not influenced by whether I'm behind or whether I'm ahead or anything like that. It's best to kind of divorce yourself emotionally from your results, and the best way to do that is just not to care about them. Now, why would I end up having a great month with all the volatility that we've had? Well, again, this is a situation where I look for situations like this. It's taken me years to be able to earn the right to be able to earn profits from these types of moves where everybody else is panicking. So let me just show you a couple of examples of the things that we had to do. And actually there was a bit of defensive scrambling that occurred during this month. I wouldn't say scrambling in terms of, there were some defensive adjustments. Scrambling is probably a poor term. It gives you the impression that we're running around like, oh my gosh, what do we do? No, we had a clear plan in terms of what to do. It was a matter of doing the right thing at the right time. So the first thing that comes into play is when we have a market that is really this flat. If you go back to some of this summer's market minutes that I talked about, I said, look, this is a really very dangerous market for an option seller because you can get lulled to sleep with this, setting up these iron condors above and just below the price. And everybody was doing great for 1, 2, 3, 4, 5, 6 months in a row or so. But this is the classic situation where you make all these profits in a row and then the next month comes along and you give them all back plus some. All back plus some. And I guarantee that a lot of folks ended up doing that, the folks that went to sleep on this pattern. Range contraction like this leads to range expansion. And it's an old lesson. It's something I've had to learn again and again, and I don't have to learn it anymore. Now, during this period, I was selling some trades along the way, and the signals that I did get were the ones to the downside. I didn't get any upside signals, unfortunately. So I couldn't sell anything to the upside with this uber low volatility. So even though it seems like this would be a great situation for something like that, it's also very dangerous to sell to the upside because you can literally be in trouble in a couple of days. However, you get a little bit more edge to the downside if you can wait for the pullbacks. If you can wait for the pullbacks along here. And my delineator for this was to only sell something that gave me a cushion of 10% to the downside. So what I was factoring in was that eventual 10% correction, which was around at the Spider 192 level. So I was selling things down here at about 190, 189 in that area, selling bull put spreads down there in that area. And as you can see, it was not enough. So I did everything in my power to set up trades well below what I figured was probably going to be a low watermark, and we ended up undercutting that low watermark. Okay, so what did I do about this? In fact, I had several positions that were at SPY 189. Now, you might look at this and say, well, why did you bother doing anything about that? The price closed above there. You could have just let it expire out of the money and you would have made a profit out there. Well, that's true. Hindsight is a real benefit in a situation like that. But when you're going through a late August move like this, you don't know where this is going to stop. Is it going to stop at 10%, 15%, 20%, 30%? We don't know. We don't know if we have another October 2008 in store for the market. So the best thing that we can do is look for specific criteria, what I call static risk management. And when that level is hit, out you go. So I don't question it. I don't sit there and bargain with it and say, well, maybe the price will go higher from here. I don't care. It's a very specific ejection point. at which I close down the trade. And now what I do is I use the strength of the move against me. And in this case, the actual benefit from this is that when we do have a move like this, the VIX goes sky high. So we have implied volatility in spades to work with on the option chain. So to give you an example of what I did with this, it's called a roll out of the position. So you can't even really see this on the daily chart. So we have to zoom out to the monthly chart to really get a perspective of what's going on here. So here's the monthly chart. Again, my original position for September was down here at the 189 level. So it was somewhere, let's call it right in there. Okay, so that gives you a sense of how close we're playing when you look out of the monthly chart. So when I close this one down and roll it out, I did two rollouts. One was to the September 156 level, and the other one was to the October 151 level. So I'm splitting the position into different rollouts, short-term, long-term, a little bit of martingaling there. I usually don't do very much of that, but when we have a situation like this where we have such a huge distance, and if we look at this, we have this massive pivot down here, right around the 150 level, or about 1500, 155 or so on the spiders. So getting something at or below that massive pivot level, I think, is very important. Because typically on a situation like this, when you have a swing level that's this strong, former resistance becomes new support, that eventually we're going to see this perhaps even tested if we roll into a bear market. But it's not going to get all down the way there in the first try. Usually what we do is we have something like this sets up, and it takes months for this level to be tested. If it did go all the way down to that level, so in other words, if we had about a 25% haircut right off the bat in the space of a couple of weeks, we've got bigger issues, don't we? So the very first thing was for me to do is to reposition that into different roll-up positions, and allowing them to be filled underneath that pivot creates a very, very strong edge, which I'm still playing out through this. So those September positions expired already today, or will expire today. And then the October positions are looking really good right now. They're only worth maybe a couple of cents, and I can even close them down if I want to close out the risk on them. So the other thing that I did was, while this pullback was happening, I went over to the SSO. Now the SSO is 2 times ETF on the S&P 500. And what we saw was this level here right around 50. You can see how this price has come down to here before and tested that level. So that also maps out to that pivot. I said that I would be a buyer of the SSO if it got down to 50 and assigned me. I'd be a welcome buyer of the S&P 500 at the $50 SSO level. So what I did was I sold actually 46 and 49 puts for September and October. So 49s for September, 46s for October. If the price is going to go all the way down there and assign me, I would be a welcome buyer down at those levels. So the September positions are going to expire today, and October's look very good as well too. I can probably clear those for just a few pennies to clear out my risk and look for a new position with that capital. The other thing that I did was, there's a strategy called an RSI2 that I use. It's a long strategy, and this is a pretty reliable strategy that in a bull market and a longer term uptrend, when we have a pullback that creates an RSI signal, just a standard old Wilder signal here with a RSI 2.0 value below 2.0, okay? Looking for situations where I can go long. And in this case, the easiest thing that I could do was, instead of trying to use an option trade, and typically when you have that much of an implied volatility spike, you want to be selling options. And so I didn't want to limit my gains on this. And buying options is really kind of a rookie issue down here, because you're buying too much premium when you do that. So unless you want to go way in the money on that, so what's the point anyway? You might as well just buy the stock. So the easiest thing I could do is buy the SSO. And so we bought the SSO down here. Actually, it was a very difficult fill because I had to chase after it. Limit orders were not being taken. I literally, for the first time in the longest time that I can remember, had to use a market order to get in on that Monday, the 24th, on the SSO. So it took a while before I was able to get out from underwater. But the point behind this trade is that not only were we looking to make money from the bottom on here by selling options against that spike, but I wanted to see the mean reversion on this back up to some level. So this is a bit of a catch the falling knife trade, but you can see that it is a very reliable setup when it does occur. It doesn't occur very often, but when it does, it's usually a very nice setup for that. So we also made money on that. Now, we can, as the price kind of narrows down and sort of vectors into another consolidation pattern, now we can look for other edges that are above the price and below down here. But that gives you an idea of some of the things that I was doing for the September cycle, where everybody else was sticking their head in the sand and screaming in pain. That's a place where the level-headed trader that's sort of been through this before can actually do very, very well and have a terrific month taking the other side of the trade. You've almost always got to be taking the other side of the trade and the other side of the emotion from the average herd of traders out there. So that's it for today's Market Minute. Have yourselves a great weekend, folks, and we'll see you back here on Monday.